Hello everyone, this is Anantha Kani. I am here to discuss about the topic accounting standard. This presentation explores accounting standards. We will examine their importance and key examples. Introduction to accounting standards. What are they? Accounting standards are guidelines. They define how companies report financials. Who sets them? Bodies like the IASB and FASB issue standards. They ensure global consistency. Why standards? Standards create transparency and comparability. This aids informed decisions. Then the importance of consistent accounting standards. Comparability, transparency, and reliability. Comparability. Standards allow comparison of financial statements. This is across different companies. Transparency. They ensure transparent financial reporting. Transparency build investor confidence. Reliability. Reliable standards ensure accurate information. Accurate data supports sound decision. Then the key accounting standards. International financial reporting standards are used globally. They ensure uniformity in financial reporting practices. Understanding international financial reporting standards 15. Revenue from contracts with customer. Number 1. Identifying contract. Number 2. Identify obligations. Number 3. Determine price. Number 4. Allocate price. Number 5. Recognize revenue. IFRS 16 leases. A detailed explanation. IFRS 16 outlines accounting for leases. It requires recognition of lease assets and liabilities on the balance sheet. All leases are treated similarly. Navigating IAS 36 impairment of assets. Indication recoverable amount, impairment loss, reversal. IAS 36 addresses asset impairment. It ensures assets are not overstated on financial statement. Companies must test assets for impairment. In conclusion, adhering to the standards for the financial success. Accounting standards provide a framework. They ensure accurate and reliable financial reporting. Adhering to these standards is vital. It drives financial success.
Hey guys, I'm myself Dhinakaran, and today we are going to talk and learn about the limitations and applications of accounting standards. This presentation is created by myself, and the limitations of accounting standards. It is rule based versus principle based. The standards can be either too rigid, limiting flexibility, or too broad, which is causing ambiguity. And the second limitation is it is subjectivity and judgment. So accounting heavily relies on estimates and assumptions, which may introduce unintentional bias. So the third one is historical cost. The focus on historical cost may not reflect current market values, impacting relevance. So the historical cost, the principle of historical cost is playing an important role on not reflecting the current values. So the fourth point, complexity and interpretation. Accounting standards can be difficult to apply and understand, leading to inconsistencies. So these are all the limitations of accounting standards. So for the next example one, revenue recognition. So the definition of revenue recognition, according to Accounting Standards Code 606 or IFRS 15, determines when and how revenue is recognized. So the limitation in this principle is complex contracts requires significant professional judgments. And the example will be percentage of completion method in long-term construction projects. So this is example one. On the example two, we have leases. The definition of leases, according to Accounting Standards Code 842 or IFRS 16, requires recognizing lease assets and liabilities. So the limitation in the leases concept is this lead to increased complexity in lease accounting and reporting. So a better example to understand about the leases is operating leases and financial leases and their balance sheet implications. So these are all the concepts that came with the example 2 leases, and the example 3 is imperation of assets. So the definition of imperation of asset is given in Accounting Standards Code 360 IIS 36, which determines when an asset's value should be written down. So the limitation in this is subjectivity arises in determining the recoverable amount of assets. A good example will be goodwill impairment testing involves complex calculations and assumptions. So the calculation of these type of asset includes assumptions and complex calculations. So this is a good example for the impartation of assets. And the fourth example will be fair value measurement. The definition is according to ASC 820 or IFRS 13 establishes framework for measuring fair value. So the limitation for the example 4, that is fair value measurement, is it relies on market data or complex valuation models. So it is completely relied on market data. And the example is it includes level 1, level 2 and level 3 inputs. So it is based on inputs and market data. And the example 5, that is inventory valuation, is defined under the code 330 or IAS 2, which establishes method for valuing inventory. The limitation will be, that is, there are different methods which can lead to varied financial outcomes. So the example is impact of inflation on LIFO versus FIFO method is significant. So the FIFO method, as you all know, FIFO method is used to evaluate or valuation of inventories, which is defined as first in first out. So it is significant. So these are all the examples of inventory valuation. Example number 5. So these are the concepts that you have learned today. Thank you.